Hi, Rob Lukey with Shop Prop Realty. Going to talk real quickly about SVB, Silicon Valley Bank, which, as we know, went ahead and was shut down, seized on Friday for lack of liquidity. I have Washington Mutual because this was the largest bank ever to fail. This was acquired by J.P. Morgan in the financial crisis. We had kind of a similar price action as we do to SVP. Is it similar? Well, it's similar from a standpoint that they both faced liquidity crisis. Washington Mutual was driven mainly by subprime mortgages. SVP, I guess you could call the exact same thing from a standpoint of loans to mainly to a lot of startups that potentially can't pay. Who knows? We won't know until we go through the books and somebody acquires them. I'm assuming that maybe before Monday, right now it's Saturday, maybe before Monday we get some kind of announcement of somebody taking over SVP. Who knows who is it going to be? Maybe JP Morgan, but somebody obviously maybe Wells Fargo, who knows at this point. So we'll see what happens. And what does this mean? Is there a possible contagion that could be occurring in the financial sector? And I'm going to go through a couple of other charts to kind of give us all an idea. I would say this is one of the more difficult times to interpret in the financial industry, at least that I've been involved with, which has been the last 30 plus years. I've seen the dot-com, I've seen the Great Recession, I saw the roar in the 90s. And why I say it is a little bit more difficult to establish is because part of this crisis was driven, the move that we saw in the market and part of the crisis that we saw happen in the environment here with SVP is also driven somewhat by the Fed, right? We have this Fed that is trying to occur to create this massive slowdown to get a handle on the inflation number. And unfortunately with that, you have these type of unintended consequences of something like this occurring. Maybe that slows down the Fed and they go, oops, maybe we're moving a little bit too quickly for businesses to adjust. I mean, this is a huge company. So let's talk about kind of the macro to micro level. Could there be additional contagion? Probably there'll be some type of impact on other institutions that are dealing, at least in small businesses, we know will be immediately impacted, not being able to have access to their funds right away. They are saying by Monday they'll have access to their funds, but maybe not all of it. But also from a liquidity standpoint, we'll see how it impacts other small businesses and startups. Again, slowing down this economy is working. I don't know if it was the way the Fed wanted it to occur. We'll see what happens. But let's talk about what might be happening on the more macro level. So here's the S&P 500. As we know, we hit that high. This was back, and we saw another move up, and this is January 22. We saw this kind of move up in the S&P. This is the move that we saw as of today. We've had a kind of this continued downtrend, and we talked about, at least I did in January, I actually shorted the real estate market on a short-term basis. I did cover it since then, but I spoke about that we're seeing this kind of high. We saw actually the high, and you'll see this in a second, a high in the S&P prior to the move in the real estate index, right? Usually this is showing a sign of something, right? Usually in the S&P 500 sector, we're seeing this as a leading indicator of what might be happening in the financials and also in the real estate market. And we had the real estate market, as you'll see, top out later in the year because we still had lower interest rates, right? The Fed started raising in here, which obviously the market saw it coming prior. And I think more people believe that, hey, you're going to see some kind of tough road over the next year to 2 years in the financial markets and in the real estate market in general. So let's keep moving through this and look at the financials, the S&P 500 financials. this is as of this news, obviously, on Silicon Valley Bank. Pretty big move down. I think that you're probably going to continue to see some type of consolidation down in here, and maybe even a further drop until we get some move or some kind of understanding from what kind of contagion could be involved there. The thing about the market that we have to remember, if you go back to the S&P 500, it's hard for the market to go and get a bull run until we have some kind of capitulation occur. I mean, is it possible that the market could have this kind of soft landing now that we've had this SVB news and the financial markets are taking such a hit? Maybe, because the Fed might change their mind, right? And that would obviously stabilize the market at least. And maybe you have some kind of Goldilocks situation where you don't have that capitulation. Obviously, we're down, 20% from the high in the S&P overall, but still a capitulation of 35% hasn't occurred, which could occur based on this. We'll have to see. Here's the S&P 500 real estate market. As I said, we topped out later, right, in the year on the S&P 500 real estate industry. If you remember from the previous chart on the S&P 500, we topped out really in January of 2022. Here's our chart on the S&P real estate market. You can see we topped out later on in the year. So these are stocks. These are the real estate index. So what's happening with actually the real estate market, home price index? This is the national index. As you can see, topped out too. We had this decline that we had occur. I think you'll actually might see a slight pop up in January, February numbers when we get them released. But what we're seeing happening is that obviously this is rate of return getting back down into levels that are manageable, right? Here we continue on with these charts. Here's the 10 cities, same type of thing. And here we have this city composite again dropping. And again, I thought this was an interesting look from the trough, what we called the trough of 2012, and where they are from, where it came from from that trough to the peak at this point, right? You kind of can see that we've already pulled back from those levels. And here we are, the year over year composite, right, is getting back down into kind of a normal price trend. This is kind of good news from a standpoint that the Fed is obviously looking for that, right? One of the things is the Fed doesn't want to see 20% increases in year over year prices in the real estate market. So this is good. I guess I wanted to go through some of these charts just from a standpoint to, first of all, talk about what is happening and understand that we might see some continuation of what I said last time in these 3 to 5%, maybe even where we're getting a slight drop in year over year prices in real estate prices. The average obviously would still be up, and that we get back into these levels over the next couple years of 4%. Are we going to see massive capitulation where we get that additional drop in the 15% in the S&P? It's possible. But I think overall we're closer to the end of this kind of move that we've had down in real estate, whether it's another 3 to 6 months of this kind of, or even 8 to 10 months of this kind of churning in the market with drops like this. I think that's probably what you're going to see. There is a good chance for a capitulation to occur. I think if it does occur, it's going to be very quick. So having some money ready to buy some equities at that point would make sense. I hope everybody has a great day. I think that long term, like I said, I think long term, you're going to see the Dow into the 40,000 range. This is in the next, 3 to 4 years. And I think that you see real estate prices take out their highs as we get through this kind of capitulation and inflation gets under control over the next year. Have a great day.